Hello, this is David Schlossberg of Assured Concepts Group, and I want to welcome you to our fourth quarter 2024 Market Intel Report. The third quarter was certainly filled with volatility around the upcoming presidential election, geopolitical events, and the Federal Reserve's monetary policy changes in an attempt to fight inflation. We saw positive returns through the third quarter with the S&P 500 posting almost 6% return, the Dow Jones Industrial Average leading the way at over 8%, and the tech-heavy NASDAQ index returning almost 3%. Those on top of a hot start to the first part of the year have led to good calendar year returns so far. Of course, all of this is in light of uncertainty around the presidential election, those geopolitical risks, and the Federal Reserve's rate cutting cycle that is just at the start. And so in this video, we're going to talk about the three key elements on the minds of investors today. Those being, what could the start of this Federal Reserve interest rate cutting cycle mean for investors? How have markets performed in months surrounding a presidential election? And then last but not least, why should investors think about market volatility as an opportunity? So let's dive right in. The first thing that I want to talk about is what could the start of the federal rate cutting cycle mean for investors? As we know, in September, the Federal Reserve kicked off its highly anticipated rate cutting cycle with a 50 basis point reduction. Now, what we typically see is when the Federal Reserve starts to cut interest rates, cash yields, which is the amount of interest that you make on holding cash, starts to fall quickly. In fact, history shows us that cash yields decline rapidly following the start of a cutting cycle, falling by 2% on average just 12 months later. Now, the significance of this is that there's a lot of historical amount of cash still sitting on the sidelines. Many of those investors were happy earning their 4 or 5% interest rate on cash. But now in hindsight, had that money been invested in the market, as I just shared with you earlier, equity markets are up 20% year to date, and more diversified portfolios would typically be up somewhere between maybe 5% and 20%, depending on the asset classes used. So cash certainly didn't outperform the market so far in 2024, but it's been a nice safe haven for liquid money that wasn't at risk. What we typically see when cash yields start to fall, those investors look to redeploy that capital where they can earn a more meaningful yield. That could be a boon to equity markets. If some of the $5+ trillion of cash sitting on the sideline starts getting deployed to things like the stock market, it could accelerate the momentum and price activity of stocks in general. Some of the interesting data points on what the market has done when the Federal Reserve starts cutting interest rates could be a telling sign for what's ahead. As we all know, history is no guarantee of what will happen into the future. But if we look at the average stock return 12 months after the Federal Reserve has started to cut interest rates, we've seen that going all the way back to 1974, the market has produced an average return of about 7.2%, the first 12 months after the first interest rate cut. Depending on whether the economy avoids a recession or not within the year, has led to very different returns. If we look at time periods where the Federal Reserve starts to cut interest rates, but we are not in a recession, nor do we go into a recession in that following 12 months, the stock market's produced an average return of 19.6%. If we contrast that to a time period where the Federal Reserve begins to cut interest rates because we're in a recession or we're going into a recession, and 12 months later, the stock market produced a return of a negative 2.7%. With that, the average is about 7.2. In times when we're not going into a recession, really bullish returns on the stock market. But in times when the Fed is cutting interest rates because we're going to a recession or have a lot of economic uncertainty, negative returns for stocks over the following 12 months. But it's really important as a long-term investor to zoom out, because 3 or 5 years later, if you look at that blue line, the average market return 3 years after the first cut is 41%, and 5 years cumulative return is over 77%. Even if we're heading into a recession or we're already in a recession, 3 years after that first cut, it's a positive 18% return. And 5 years after that first cut, it's a positive 57% return. So again, we want to make sure we're maintaining a long-term perspective within our investment strategies. Money for income over retirement over the next couple of years, or your emergency fund, cash might be a great asset class to keep that in. But if you want to maximize the growth and return on your money, and you have the right time horizon available to you, now could be a good time to continue to stay the course with your longer-term strategic asset allocation plan. And the flip side is, as of today, the economy shows no sign of an imminent recession. But as we all know, this has the potential to change. The next thing I want to talk about is the United States presidential elections and historical patterns in markets, volatilities, and returns. Politics are incredibly important for individuals, and many have gotten quite passionate over politics. But it's not really for the stock market. The stock market is an incredible information processing machine that is processing all kinds of data points on a corporation's ability to produce future cash flows and earnings. Politics do play into that. Indeed, they do. But they're just one of many, many factors. One thing that we've seen in historical patterns around election years is that as we lead into the November election date, we see increased volatility in the stock market. If you look at the chart that I'm going to put up in the video, the dark blue line represents the average monthly volatility in an election year, whereas the blue bar represents the average monthly volatility in a non-election year. You can clearly see that as we approach election day, September, October, November, we see a lot of heightened or increased volatility in the stock market. Once election day comes and goes and the results are in, we start to see that volatility dissipate. Similar trends can be seen in stock prices, which on average have been choppy beginning in September and lasting into the November election. But post-election through the end of the year, we typically, but not always, see a rise in stock prices. On average, an investment made on November 1st of an election year has rallied over 16% in the 8 months following an election, and it went on to gain 11.6% annualized over the next decade. So if you're asking yourself, is now a good time to be in the markets? Or maybe you have some cash on the sidelines. As you can see, based on historical data, we've typically seen an increase in stock prices. The last thing I want to talk about is how periods of elevated volatility may in fact represent an opportunity for investors. The VIX, or the volatility index, often is referred to as the fear gauge in the stock market. It's a real-time measure of expected near-term volatility. Historical examples show that during the global pandemic, the VIX was over 55. When the tech bubble burst in 2000, it ranged between 45 and 55. And following the market reactions to 9/11 in 2001, the VIX was between 35 and 45. Understanding this is important because volatility is a feature of investing, not a defect. Many investors instinctively view it as something to fear and avoid. When markets become volatile, people often think they should cash out or move to more risk-off assets, which could lead to subpar long-term performance. But typically when the VIX is high, it's too late to move aside. Since markets decline faster than they increase, high volatility typically identifies a declining market. Any stock investment made at any time yielded a solid average one-year return of 9.7%, with many variances, including declines, of course. However, investments made on days after the VIX had been elevated performed significantly better. Thus, investors could benefit from viewing the VIX as an opportunity index. Historically, some of the best investment opportunities have arisen following periods of elevated volatility. For instance, when the VIX was 55 or higher, the following one-year return was over 31%. Similarly, during times when the VIX ranged from 45 to 55, the S&P's one-year return was nearly 33%. This illustrates that behavior can greatly impact whether investors meet their long-term goals and objectives regarding investment performance. Although it may seem counterintuitive to remain invested during volatile times, historical trends suggest the opposite is true. If you have any questions, please don't hesitate to reach out to your advisor. They can help discuss your portfolio construction and ensure that your investments align within your volatility tolerance, putting you in the best position to achieve your personal goals. Thanks so much. I'll look forward to seeing you next quarter. Again, if there's any questions, please feel free to reach out at any time. Thank you very much.